So there's some trade management we need to talk about regarding two of the open positions. And it's particularly important when we consider that we may want to re-enter some of these, and we have to make sure we're managing these lots as effectively as possible. So let's jump into the euro yen here. This is one that was really interesting in terms of the way it led up into non-farm payroll and the way it launched higher. So the reality for this trade, and you can see I've already done the arithmetic on the entry from the 24th. We've been managing this entry from 131.45 since March 24. And one of the things that I wanted to emphasize, and I hate typos, there we go. Although they're only typos because you catch them after the fact, right? All right, so you take a look at the 131.45 to 130.20. I basically laid out the arithmetic of a 4-lot entry with the total number of pips. Now, a number of traders, because we had multiple downside targets, 2 optionals and 2 profit targets. When I say optionals, they're exactly that. You can choose to take it or not take it. It will sell you out of the trade more quickly, but it will also allow you to reduce your risk as you realize profits versus just kind of leaving unrealized profits to float. So there's 2 scenarios here. I know that traders took the 130.20 and you had to take the 129.60. Those 2 targets, the optional and then the non-negotiable at 129.60, allowed us to move from the risk-based POV stop loss to a break even, which is 131.55. For traders who took those first 2 profit targets, of the 4 lots, 3 of them are off the table and you've got the 1 lot left. So 2 at the non-negotiable, 1 at the second target, and then if you flip this around and you wanted to use 130 as the first place you use to start to ratchet your stop, this is huge, gang. The first place you realize a profit is when you actually say this trade is a winner, and that's when you must move to a break even, okay? So what happened here is it ended up being 2, 1, and then 1 lot left. Now, going into non-farm payroll, a lot of traders wanted to kind of tighten the screws on this trade and say, look, I've got an opportunity now to take a 128.80 from the 131.45 and pocket another 265 pips. I'm doing that, but I'm flat. So what's the risk? Well, the risk to your capital is 0. The only risk here is what if. It's the what if risk. It's the what if the market continues to move lower towards 127.50. What am I leaving on the table? Some traders don't concern themselves with that, especially when, quite frankly, they just finished taking 700 pips off the table across 4 lots. For a lot of traders, that's great. And then you reduce your risk to nothing by having no exposure to non-farm payroll. That's a pretty darn good exit. So I know a lot of traders opted to do that. The other alternative is you still have the 1 lot open, and I left that at a break even. So I still have 1 lot open with a 131.55 after taking a 250 pip winner across 2 lots in this pair, and then another 185 pip winner. And I've actually also re-entered the market from 130.80. And all the profit targets to the downside are still viable. You know, 130.20 is an optional. 129.60 is, again, the first non-negotiable profit target. So you can see we're basically hovering just below the entry. This is not a winner yet. I haven't had an opportunity to take 130.20 off the table, even if I wanted to. And I definitely have the desire to take 129.60 off the table. Again, that is non-negotiable. So for some of you, this is essentially a really nice closed trade, really an excellent closed trade. And for others of you, you're looking to see if that euro yen will sink. What's going to be the catalyst for that euro yen sinking? You know, maybe it's going to be the FOMC minutes on Wednesday. Maybe it's going to be, quite frankly, the market opening with full participation with tonight's Asian session. Remember, we're coming off 2 bank holidays. So maybe that's going to be part of the follow-through as well. But the U.S. dollar strength that we saw midday, weakening the euro, was really a nice follow-through for us dollar bulls. And if you're a euro bear, you are, on the flip side of that coin, a U.S. dollar bull. The other trade that we had was the New Zealand dollar, Canadian dollar, and this trade On Friday, the first leg of this trade, the 94.20 was closed. So 94.20 got closed at the optional 94.70 for a 100 pip winner, and boom. So two lots across that entry, 50 pips each, 100 pip out. The next level we were watching was for the 93.80. Now remember, first in, first out for those of you here in the U.S. would basically mandate that 94.20 gets pulled first. I know a lot of you are working your trades, your Forex trades across multiple accounts. That's also very, very helpful. And I know a lot of you still are outside the U.S., so you're not bogged down with the ridiculousness that is FIFO. And others of you have brokers who are actually FIFO compliant in a much more flexible way. So the actual compliance across different brokers is very different. So you have to talk to your broker in terms of how they follow FIFO. It is executed very differently across many, many different brokers. So 93.80 is still an open trade, but 93.80 is down to one lot. We had two lots at 93.80. We rode those two lots higher from 93.80 to 94.90 for a single lot winner of 110 pips. And now we have still one lot to see how high is high, or essentially now this whole thing's been ratcheted into a break even. So the sum total of my risk for that one lot is all the unrealized pips, of course, but really, as far as my capital is concerned, the real risk is 5 pips. So one of the things I like to say is, show me your stop and I'll show you your P&L. At this point, if I lump together all 4 of those lots, it's 100 pips already pocketed, another 110 pips already pocketed for 210 pips, and then I have potentially a single lot with a 5 pip risk. There's your subtract 5 pips from your total. There is that 205 pip winner on New Zealand dollar Canada, worst case scenario. Best case scenario, we get another shot at 94.90. Or better, this thing starts to rally on New Zealand dollar strength and Canadian dollar weakness into the 95.45 level. When could we see that? FOMC could certainly rock the market on Wednesday, but don't forget we have Canadian unemployment and employment numbers on Friday, and then we have the BOC next Wednesday. So that employment release could be very volatile as traders try to discount what they believe then the BOC will say and do. Will they cut again? That would be a great move for this particular entry, Canadian dollar weakness, but will they cut again? Those employment figures might clear the discounting up, and it might initiate some serious selling in the Canadian dollar. We'll see. These are just ifs. But all I've got is the one lot, 5 pip risk, and that is some trade management for 2 of our recent entries. Euro yen and New Zealand dollar, Canadian dollar.